All right, so this is the investing in commercial multifamily for cash flow and long-term wealth. Uh, and we're just going to talk just a little bit about our philosophy behind how we approach purchasing commercial real estate and also specifically commercial multifamily real estate. So today we'll talk about a few things. We'll talk about ourselves, Prosperity CRE. We'll also talk about the different types of apartment investments that are out there. We'll go through a little bit of the long-term multifamily performance history versus stocks, bonds, and other asset classes. Also, the unique combination of economic returns balanced against that. The long-term demographics that support multifamily and why we think it's an evergreen asset class to invest in. Also, investing for passive cash flow and long-term wealth, which is something very important to a lot of our investors. We'll also talk a little bit about how we like to target strong markets and the exact type and grade of multifamily that we choose and why. So before we get started, we just always like to put out a disclosure. This is a presentation by us, Zach Winter and Mark Rios from Prosperity CRE. It's all for information purposes. These are all our own opinions. This is not a security. We're not selling any type of security, although any investments that we do present to investors, we are SEC compliant, so they're usually offered pursuant to Regulation D, Rule 506B or 506C. Also, Prosperity CRE, myself and Zach, we are not professional tax advisors. So any of the tax strategy concepts that we put out there for you guys to consider, they're just for illustration purposes, and they're not considered professional tax advice. Please consult your advisors. All right, a little bit about ourselves. We are Prosperity CRE. My name is Mark Rios. I'm one of the co-founders. We co-founded Prosperity CRE, myself and my partner, Zach Winter, about 2 or 3 years ago. For myself, I'm a licensed NMLS loan originator. I'm also a licensed California realtor. So I'm able to buy and sell houses, help people buy and sell houses, as well as originate residential loans for them. I have a company called TriSource Capital, which is a commercial real estate mortgage brokerage and structured capital firm. Over the last few years, we placed probably about 44 million in structured capital and credit facilities for third-party clients. I've also been a real estate investor for over 17 years.
And I'm Zach Winter, partners with Mark in Prosperity CRE, and I'm a licensed attorney, although at this point I don't represent third parties in litigation or transactional legal work, full-time real estate investment. And I've been investing for over 20 years and been investing along with passive investors investing alongside me since about 2012. I'm also a former real estate broker, mortgage broker, previously owned and operated brokerage companies, a real estate company, and escrow company.
So we are Prosperity CRE. We consider ourselves a real estate acquisitions and asset management house. We generally purchase a larger commercial real estate through syndications, which means that we bring together varying amounts of investors to invest passively alongside with us in order for us to buy bigger buildings. All of our investment properties, they have been profitable. We've never had a capital call. We've currently are general partners on about 7 properties in commercial real estate. And under that portfolio, we have about 365 plus units of multifamily. All right, so knowing that we really like commercial real estate, we're going to just drill down to why we think that commercial multifamily is the best asset class to invest in. We'll start with just the size of apartment complexes that we feel is the best, and I'll go through just a few of them and talk you through the differences within each. But the very tip top within the whole apartment sphere, we have what we call residential multifamily apartment buildings, and these are usually the 2 units to 4 units buildings. And so at the core, multifamily really is, it's just a residential structure with more than 1 dwelling residence in the same building. That's the easiest way I can kind of talk about it. So within that, you have single family homes. You also have duplexes, triplexes, and quads. And from a lending perspective, if you're looking at 1 to 4 units, it's the same type of residential loan that you can put on a single family home. And you can also just put that in a duplex, a triplex, or quad. And so what that means is that you can go out and get a residential loan and live in one unit and then rent out the other units. More than likely, though, you will not be able to achieve the same types of economies of scale that you would with larger apartment buildings. So that brings us to what we call small apartment buildings. These would be the 5 to 70 unit types of buildings. Now, officially, according to the census, 5 units and above are considered commercial multifamily. We call them small apartment buildings, and really what it comes down to is just the staffing that's involved, which means that with these smaller type apartment buildings, the income that's being produced and the expenses that are also being incurred, it's very difficult to have professional staff working full-time on the property, right? Usually the property management company that you hire, although some of them can be very enthusiastic, they're usually mom and pop shops and they're not as professional as you might want them to be. Also, you'll have possibly situations, especially on the smaller side of this, you'll have situations where you'll have maybe a part-time maintenance person who may be working on other properties, or they may be a live-in, so you might have to exchange possibly free rent concessions in order for them to have discounted rent as part of their pay to work on the property. Handyman, things like that. And then when big expenditures come up, you'll have to go out and contract it out with professional companies. And then on the management side, it's very difficult to have full-time management. So you'll see part-time managers, maybe a live-in manager, and they'll also be sharing duties as a leasing agent as well. So because of the staffing, you're going to see more volatile returns in this smaller space, in this 5 to 70 units. And in terms of lending, right, these smaller apartment buildings in most areas, they're going to come with a smaller price tag, and so they're more difficult loans to kind of take down. They're going to usually be full recourse loans, and what that means is that the lender is looking to you, the owner, as the debtor, and they'll be looking at your full credit, your own debt to income ratio a little bit less than they're looking at the income of the property. So there's much more risk to your personal credit. And also, like I mentioned, there's a lower tier property management, so there's more risk there. The space that we like to kind of play in is in commercial multifamily. When we talk about commercial multifamily, we consider that the 70 to 400 plus unit space. And just as a side note, through the downturn from the 2008, 2009, and 2010, commercial multifamily was really the only commercial real estate asset class that was able to get non-recourse lending consistently through the downturn. And so that was a testament, kind of an evidentiary testament to the quality of the asset class, where lenders felt very, very comfortable putting loans on the property, making them non-recourse, where they could only go after the property rather than you. For collateral, all right? They've had a long track record of positive returns. Of course, when you get bigger, like I mentioned, the professional third-party management is critical. And when you start getting 80 units and above, you start being able to afford full-time staff. So full-time property manager, they'll do some leasing there, and a full-time maintenance person as well on board. This is the size that is typically held by private equity real estate groups like Prosperity CRE and bigger. Also, it's the property size that REITs own, usually in a bigger space, so 150, 200, 300 units is what they'll own. And also AAA life insurance companies. The big part of their portfolios is to own larger multifamily buildings.
So now that we've kind of defined the different categories of multifamily properties, let's take a look at what the key benefits are of investing in multifamily. And we refer to these key benefits with the acronym TCAP or TCAP. So the first major benefit of investing in commercial multifamily are the significant tax benefits of when investing in commercial multifamily. It really is one of the most tax advantaged asset classes. I'd say commercial real estate, along with oil and gas and farming, are the 3 top industries that are the most tax advantaged industries in the US. So if you look at it kind of along a timeline, when we acquire a commercial multifamily property, one of the first things we'll do after acquiring it is a cost segregation analysis. We hire a special firm that specializes in conducting a study on the property called the cost segregation analysis. And once we have that study, it gives us the ability to accelerate the depreciation tax write-off that we're able to take each year on the property. And by doing that, accelerating the depreciation tax write-off, it gives us the ability to significantly, if not entirely, offset the income stream that you as an investor are getting on that real estate investment. So for example, it's quite common for our investors to get quarterly distributions each quarter off of the cash flow of one of our investment properties. But when they get their K-1 tax return at the end of the year, it actually shows a passive tax loss that they can apply to other passive income or roll forward to offset future passive income in future years. So that's a very, very significant tax benefit that you get when investing in commercial multifamily. When you do that, to the extent that you're completely offsetting your net investment income, you're also eliminating a new tax called the ACA tax, or the ACA Affordable Care Act investment tax, which is 3.8%. So if you don't have any taxable income, there's no ACA 3.8% tax on top of that. So you're also eliminating that ACA tax. In addition to that, one of our major strategies is to acquire property and implement a value add strategy or several value add strategies that increases the net operating income in the property. And that is also increasing the overall equity in the property and increasing the value of the property. And so at some point in the holding period, we'll want to harvest that lazy equity, typically by doing a cash out refinance or a supplemental second cash out loan, and taking that cash and returning it to the investors. And when we do that, when we give the investors back that cash, we treat it as a return of their initial investment. And that's not a taxable event. It's a return of your initial capital. And what we also will look to do at that point in time is look for opportunities for our investors to reinvest that capital that was returned to them into a second property. We call that cascading up. So they're cascading up and essentially acquiring two properties now for the same amount of initial capital. And they have two income streams and two properties which are growing in equity and value. And then another significant tax benefit is the 1031 exchange. And that basically is when we go to sell the property, we'll again look for opportunities to acquire another larger property with potentially greater cash flow and equity growth. And those investors that want to continue to receive cash flow and grow their equity and long-term wealth can roll their basis forward into the next property and their investment into the next property. And when they do that, the sale of the initial property is not taxable. So they're not being taxed on the sale and the profit they're getting from the initial property, and their investment rolls into the next property. And that's a second example of cascading up into another property that's providing greater cash flow and greater long-term wealth generation from a non-taxable basis. So in addition to those several significant tax benefits, another major benefit from investing in commercial multifamily is the ongoing cash flow that you receive. Our investments, we make quarterly distributions of the net income from the property. So as an investor, each quarter we'll take all of the gross rents and any other income streams that are being generated by the property. We'll deduct the ongoing operating expenses, pay the mortgage, put into reserves any amounts that need to go into reserves, for example, for future capital expenditures. And then all of the remaining amount is cash flow that's distributed to the investors. And you can typically, for commercial multifamily B-class properties, which is essentially what we're targeting, you can typically expect to receive 5 to 7% or more in annual cash flow from that investment. And then the next major type of benefit from investing in multifamily commercial real estate is appreciation. So usually when people think about appreciation, they think about the appreciation in their home. And the value of your home is really based off of the value of similar homes around it. So if you were to sell your house and the buyer is going to get a loan, they'll hire an appraiser to come out and appraise the value of your home. And the way that appraiser will value it is he'll look at similar homes, typically within a half-a-mile radius, that have sold in the last 6 months. And he'll determine a value range for your home based off of the comp sales of the homes that sold around you. Well, in commercial property, the value is different. The value is based off of the net operating income. And so with our properties, once we acquire a property, we're implementing a value add strategy or strategies that increases that net operating income. And we're forcing appreciation in the value of that property by increasing the NOI. And so typically we look to achieve 5 to 7% or more in annual appreciation by implementing our value add strategies. And so you can see already, if you add up the cash flow that we saw on the prior slide, plus the annual appreciation of 5 to 7% or more, we're already in double-digit returns with a nice balance of both cash flow and ongoing equity growth in a very stable asset class. And then the final main benefit of investing in commercial multifamily is principal paydown. And a lot of times, beginner investors, when they go to invest in their first investment property, they'll think about buying, for example, a single family home or a townhome or a condo, or moving out of their primary residence and buying another home, but then renting out their primary residence. And the main strategy is put in a tenant, and the tenant over time will pay down their mortgage, and eventually they'll own that property free and clear. And there's absolutely nothing wrong with that. That's a strategy that's been employed for years and years and years, and it absolutely can work. It's just that it's a very slow strategy. You're looking at 3 to 4% annual growth in equity from over time from that principal paydown strategy. So it's a strategy that does work, but it's a strategy that we like to employ along with these other strategies that we've discussed, the significant tax benefits, the cash flow, and then the forced appreciation creating greater equity gain. And then when you tack on this additional 3 to 4% in principal paydown, it really adds to your overall growth. And the nice thing about principal paydown with multifamily is it's really your tenants paying down your mortgage through the rental payments. So now that we've looked at the main benefits of investing in commercial multifamily, how does it compare to other types of investments? How does it compare to stocks, to bonds, to publicly traded real estate investment trusts or REITs? Well, first of all, commercial real estate is what we call an evergreen investment asset class. It's essentially food and shelter. It's shelter. And it's something that can never be disintermediated. It can't be blackberried. It can't be horse and buggied. It can't be Kodak. There's nothing that's going to come in and upset the ability or the need for people to always have a place to live. It's also got a very, very favorable historic, both occupancy, high occupancy rates, and ongoing consistent rent growth. And I'll show you a chart in a minute that illustrates that. It also has the best Sharpe ratio, and that's a ratio that looks at not only ongoing returns, but also risk and volatility, and combining both risk and volatility with ongoing returns. It has the best Sharpe ratio of any investment class, and we'll show you that as well. It's also been a terrific hedge against inflation historically, and it's also resistant to the economic cycle. Commercial multifamily is more tied to long-term demographic trends in household growth than it is to economic cycles, which typically are 7 to 10 year cycles. So this is a chart going back from 2006 to 2018, showing the commercial real estate occupancy on a national level. And you can see it's historically been very, very favorable in the low to mid 90s. And even if you look at the downturn, the Great Recession in 2008, 9, and 10, it still stayed at 90%. It didn't drop below 90%. So it's a very, very strong property type. And in addition to consistently high occupancy, it's also had consistent rent growth, year in, year out rent growth. So again, you can see the worst was in the Great Recession. Rent growth dropped 5.4%, but it bounced back. And within 3 years, it was at essentially flat, and the next year you started to see positive rent growth again, and it's been consistently strong since then. So historically, very strong track record of consistently strong both occupancy and ongoing rent growth. And when you compare, and this is just looking at the income, it's not looking at ongoing equity growth, it's not looking at the tax benefits that we talked about, it's not looking at the principal paid out. But if you just focus at the ongoing income or cash flow, real estate has consistently outperformed on a long-term investment standpoint. It's consistently outperformed both stocks or equities, bonds, and even publicly traded REITs. This is a graph of the Sharpe ratio, which I had mentioned. This is looking at both annualized total returns over a 20-year period, as well as annualized risk or volatility. So you can see commodities in the bottom right corner, very, very high volatility, but very, very low returns. And commodities really aren't a long-term investment. They're more of a hedge against investments in goods. But then you have government bonds and corporate bonds, relatively low returns, 4 to 6.5% returns. but also very, very low volatility. And compare that, for example, to large and small cap stocks, much, much greater volatility. In fact, the small cap stocks are somewhat close to commodities. But what's interesting is look at core commercial real estate. It's a very nice blend of low volatility, similar to the low volatility you see in government bonds, but it also has actually greater returns than any of these other investment classes. And this is all commercial real estate. If you were to strip out and just look at core multifamily commercial real estate, the annualized returns would actually be higher than core commercial real estate, and the volatility would actually be less than core commercial real estate. So this is a chart that's looking at the annual volatility levels of commercial real estate, and that's that gray bar at 7.4% annual volatility, and compare that to the other major asset classes. The other major asset classes are about 3 times as high as core commercial real estate. And it's, you know, the volatility is something that can really hurt you. We view volatility as a big negative. If you're a day trader, you really rely on that volatility. You rely on the fluctuations in price, and volatility is necessary to make large profits in day trading. But if you're a long-term investor, volatility is actually a bad thing, and that's because losses hurt more than gains help. Warren Buffett has this favorite saying, the first rule of investing is never lose money. The second rule of investing is never forget rule number 1. And part of that is because losses really do hurt more than gains help. And I'll give you an example to illustrate that. If you invested $100,000 and you had a 20% loss in that investment would be worth $80,000. But to get back to that $100,000 initial level, you would have to have a 25% gain from that $80,000 level. If you had invested $100,000 and it had a 50% loss, it would come down to $50,000. So you would then have to have a 100% gain to get back up to that initial $100,000. So losses really do hurt more than gains help. And so that's one of the reasons commercial real estate is really a much more stable investment than investing in the stock market. If you were invested in the stock market, for example, in the year 2000, it would take you until the year 2013 to get back to that same level. The stock market essentially had a huge dip in 2000 and traded sideways for many, many years, almost a decade and a half. And it took until 2013 to get back up to that same level. So commercial real estate historically has also been a very, very good hedge against inflation. And so if you look at, again, just the net operating income annually, going back to 1995 to 2018, that's the blue line on this line chart. And you compare it to annual inflation as indicated by the Consumer Price Index, you can see historically it's consistently had a higher return, just the ongoing net operating income, not counting all of the other benefits that we've discussed, consistently higher than inflation. It just dipped slightly below during the Great Recession around 2010, but then it quickly bounced back. So historically, it's been a very good long-term hedge against inflation. It's also consistently had many, many more up years than down years. And part of that is because it really is resistant to the economic cycle. It's more tied towards long-term demographic trends, which are on 20, 30, 40-year cycles versus the economic cycle, which is typically 7 to 10 years. So in this chart, this is an illustration of the up years versus down years in real estate, stocks, and bonds from 1934, the Great Depression, all the way up through 2009. And during that large time period, real estate had about 71 up years versus just 7 down years. So if you compare that to stocks had approximately 55 up years and 20 down years, and bonds about the same. So, you know, it's not that stocks and bonds are bad. You can do well in stocks and bonds. It's just that there are many, many more down years than compared to real estate. And if you were, for example, to retire during one of those down years and you were heavily invested in stocks and bonds, you know, what does that do to your retirement plans? So it's at a minimum worth considering diversifying at least part of your portfolio into commercial real estate to help lower that volatility that you see in stocks and bonds. And so this is, again, kind of another way of looking at the fact that commercial real estate isn't on the economic cycle, and it's not correlated to investing in stocks and bonds. So it's a good way to diversify your portfolio out of that extreme volatility that you can see in stocks and bonds. And what's interesting about this chart is if you look at publicly traded REITs, because sometimes an investor may think, well, I'll just invest in a real estate investment trust, and that way I'll be diversified into commercial real estate. But in fact, if you look at this chart, publicly traded REITs are very, very correlated to equities or stocks. So they are much more tied to the economic cycle and the stock market, because in fact they are publicly traded stocks.
Great. And so we talked just a bit about commercial multifamily, kind of how the performance indicators really stack up towards investing in commercial real estate and commercial multifamily. And now we'll just talk a little bit about the demographic trends that we see that support ongoing multifamily demand going into the future. So long-term, from a very kind of high 30,000 foot, what we really, really look at is we look at population growth and we look at household growth from a very kind of macroeconomic standpoint. And multifamily demand is driven by those two factors in a big way. So looking at the US population, it grows about 1.1% per year. And if you look at this chart here, this is from 2017, we had about 326 million people. And just kind of projecting forward, you can see that there's some projections. This is Census Bureau numbers, estimations. There's going to be an addition of about 38 million more people by 2030. And by 2045, there'll be about 68 million more people by 2045. So if you're thinking just on that 2030 number, in order to kind of grasp the amount of people coming into the U.S. population during that time period, think of it in terms of cities the size of Dallas, and imagine roughly about 15 more cities the size of Dallas in population terms coming into the U.S. population. So a large, large amount of people. And not only do we just look at gross population growth, but within those numbers, we look at figures that are called net migration, basically, or net population. So we look at births, we look at deaths, we also look at international migration. We'll talk a little bit about how international migration affects commercial multifamily and how most international immigrants become renters for a very long period of time. And so when you're looking in terms of how quickly people are being added to the population, there is basically a net gain of one person every 18 seconds being added to the population. This chart is a great chart that just talks about populations in terms of generations, right? Because when we're looking at demographics specifically, the biggest cohort of renters in our space in multifamily are the 18 to 35-year-olds. And then behind that, you'll see another chart that shows the older groups kind of coming on strong in terms of renter base. So looking at on a generational kind of level, you can see the baby boomers who were born between 1946 and 1964. Back in 2010, there were roughly about 77 million people. It's one of the largest population groups that we have here in the United States. Then you see a dip with the Gen Xers, that's the 65 to 1976 group. They were down to about 50 million. And then the Echo Boomers back up and matching the baby boomers. And they're almost identical. They're right around 77 million as well. And so you can see that these are two very, very large population groups. For the baby boomers part, they have pretty much driven the economy for a very, very long time. And now the Echo Boomers, which we also call lovingly the millennials, they are also driving the economy going forward. And along those lines, if we're talking just sheer renter groups, right, you can see all the way to the left that 25 to 34-year-old age range, that's the left column over there. And typically we look at 18 to 34, but 25 to 34 is very close. You can see they are the largest renter group by far, with about 1.6 million households. But then you also see it kind of dips downwards all the way to the 55 to 64s. Those are the baby boomers. And what's very interesting here is that they're coming on strong with 1.9 million households. Even though the percentage is slightly smaller, they have the most new renter households within this time period of 2006 to 2014. So 1.9 million for the baby boomers, and then 1.6 million for the millennials, and then everybody else in between. And balanced against that, also you have millennials who, unfortunately, they're not moving into home ownership in a way that is meaningful. So you can see the round charts there. Back in 2000, the under 35 home ownership rate, which is the same cohort as our modern day millennials, they were first time buyers in the 41% range. Somewhere around 2007, which is the peak of the housing market before the downturn, the first time homeowner rate was right around 43%. And then if you look at 2018, and this is well past the recovery, we're still only about 37%. And there's various reasons why millennials have had a hard time getting into home ownership. Part of it, a big part of it is just by choice. There's a lot of young people who have decided that home ownership isn't as important as previous generations. But other ones are, for the ones that want to buy, they've had troubles gathering up down payments. Student loans, student debt is really, really big right now. So it's very difficult to take on a mortgage or even save money for a down payment. The debt to income ratios, right? The structures of the criteria for lending changed dramatically after the downturn. And so one of the biggest qualifiers is what they call the debt to income ratio, which increased significantly and made it more difficult for people to get into residential real estate loans. Also, credit restrictions. Alongside, you have what we call the gig economy, and what that means is that a lot of the younger people nowadays, coming out of the recession, there's less and less W-2 wage earners and more 1099 workers. And we call that the gig economy, a lot of self-employed people. And so one study actually predicts that by 2020, which is next year, 42% of all self-employed people that are out there will be millennials. So you can see how that demographic is definitely driving the economy. And this is a great chart because it shows the percentage of homeowners versus renters. So the percentage of people that own homes is in the blue and the renters are in the orange. But it also talks about the population, or sorry, the generations that we're talking about. We have the baby boomers, and you can see it takes a dip right there with the Gen Xers, and then it bounces back up with the millennials. But one group we haven't talked about so far is what they call the Generation Z folks. And those kids are, right now they're probably age range, I'd say 10 to maybe 20 years old. And they are estimated currently, they're at about 90 million people in the United States. And that was in 2017. So they're even bigger than the baby boomers and the millennials. And so if you look at this chart here, you can see that the baby boomers, in terms of renters compared to homeowners, they're about, I'd say 20-25% renters. And Gen X, they didn't really move much. It's still under 50%. And then all of a sudden you see the millennials just jumping up quite significantly, so that towards the end of their age range, you can see them, they're probably in the 70 to 80% renter. And we can only imagine, as these young adults in the Generation Z come online, that they will be majority renters as well. And just by sheer magnitude of the numbers involved, we anticipate that their renter group will be very, very strong, if not exceeding the millennials' percentages. And alongside that, we also have, and these are just long-term demographics that we feel are supporting multifamily going into the future. So out of the economic downturn, you have what we call boomerang kids, right? These are kids that really, they haven't left the nest, or they call them, what is that? There was a movie with Matthew McConaughey called Failure to Launch. So these are kids that either haven't left the nest, or they went out into the world, had some troubles during the downturn, and these are mostly millennials, and then they moved back in with their parents. And why this is really, really important to look at is because there's a hidden demand sitting right here. So you have statistically, you have, say, baby boomers, some Generation Xers who own their homes, and but they may have a certain amount of the boomerang population living inside their homes. And so if you imagine when those kids decide to get out into the world and get back out there and start their lives again, more than likely they're going to be renters when they come back online. So there's a large hidden kind of demand there of future renters. And so if you look at this chart here, you can see that it was pretty steady right there, right in the, I'd say 19, what is that, about $19 million range up until about 2007. And then all of a sudden, it jumps, and that's because of the downturn. The boomerang population jumps all the way up to 31-32%. And so what you have here is a big a very large demand. And just imagine this, that for every 1 million in population, 3%, 1 million in population on this chart basically equals 3% of the renters, potential renters that are sitting at home. Coupled along that, you also have the divorce rate, right? So looking at from 1994 to 2018, you can see that as people get more and more divorced, new households are basically being formed. And a lot of times that also means that instead of going out and getting a divorce and buying a new house, a lot of those divorcees are renting as well. So basically that equates to about from 1994, that equates to about a 1.2% growth rate in divorcees. And that's another portion of hidden demand for potential renters. And this chart here is a great kind of counterpoise to what we were just talking about in terms of renters versus owners. And so you can see here that from 2007 to 2015, on the ownership side, right when we hit the downturn, you can see that the ownership levels actually went negative. There was very strong ownership building all the way up through 2006, and then 2007, we lost a lot of our homeowners, right? People just weren't able to buy during those periods. But on the flip side of that, if you look at the same time period on the other side for the renters, you can see from 2000, actually there's been steady growth from 2001 all the way through 2015, but it really kicks into gear from 2007 through 2015. And so the one that I really like to see is that 2013 to 2015, where you can see that for those 2 years, over 1 million renters came onto the rental market, which is just a huge number there. And this is just another way of kind of looking at the same thing. So just in terms of some of the major markets, you can see that the homeownership rate has really kind of dropped. So that horizontal line there is the U.S. average. That's the U.S. average just in the total home ownership rate, right? And then the vertical line, I'm sorry, that's the change in home ownership rate, the average somewhere around, I'd say, negative 3.5%, somewhere around there. And then the vertical line measures the total home ownership rate, which is sitting roughly about 64.5%. So you can see that a lot of the major markets are still, the home ownership rate is still falling. San Diego, Las Vegas are above the average, but still negative, with the baseline being at the very top. And one of the other demographics that we look at is how easy is it for people to pay their mortgage payments versus paying their rent, right? And if you look back in 2006, at the height of it was the height of the single family home market. You can see the big discrepancy is about $740 between being able to rent and actually affording a home payment. So it's very difficult for people to it was easier to get into loans, but the payment structure was very high, especially at the height of the market. And then of course, during the recovery, that distance between the two, that gap shrunk to almost minimally. It was almost just as easy to pay your mortgage payment as it was to pay your rent. And then slowly but surely, it's been starting to rise from about 2012 all the way through the current 2018. That gap has been increasing. Not quite as big as before, pre-recession numbers, but it's still increasing more and more. And it makes it more appealing, especially in some markets, to rent rather than consider purchasing a home, considering all the difficulties there are in trying to get a home loan nowadays.
Okay, so now that we've looked at the strong demographic trends that support investing in commercial multifamily real estate and the many benefits we have from investing in multifamily, let's take a look at how we go about identifying markets that are very strong for multifamily investment opportunities. So when we're looking at markets, we apply well over 20 different data points to analyze a market to determine whether it's a strong market for multifamily investing. And we at Prosperity CRE, we only want to invest in markets that we think are the strongest in the US. And so what do we look at when we're making that assessment and that calculation? We're very, very data driven. We look at a number of different data points. We'll look at the current population. Is it large enough to meet all of our requirements? We look at the growth in population. How quickly is it growing? How consistently is it growing? Is there a net migration of people moving in versus people moving out? We want to look at the housing prices, and Mark talked about variances in your mortgage payment versus your rent payment, and so we'll look at those types of factors. We want to look at the how safe is it to live there, and is crime elevated or is crime low? And are the crime rates trending down over time? We're also looking for strong employment growth, strong job growth. We want to see low unemployment numbers. We also want to see a very diverse economy. We don't want to go into any markets that are solely dependent on one industry. We're not interested in going into markets that are solely dependent on a military base. We're looking for good, diverse economies that support both white collar and blue collar jobs. And in particularly, we really like markets that have some type of a strong STEM presence, or science, technology, engineering, and math related job presence that's growing. Because we think that's a strong area of the economy that's going to continue to grow over time. We also look closely at the schools. Since the type of property that we're investing in is multifamily, that will frequently have young families with kids that are going to school. We like to look at the school districts and the particular schools, and are they strong schools that people are going to be attracted to, that families are going to want to relocate to. And since we're investing in multifamily, we also want to look at historically, how has that asset class, that property type done? Has it had consistent rent growth in this particular market? Have vacancy rates consistently been low? And what about housing vacancies? Have housing vacancy rates consistently been low or high? Is it an affordable area? Are people going to move there because it's affordable, or are they going to leave that area because it's very, very expensive to live there? And we also look at the cost of purchasing multifamily. Frequently, one metric that we look at are the capitalization rates, or the cap rates. Because ultimately, if you're paying too much for a property, your mortgage payments are going to be too high to make it cash flow. And one of our key metrics is we want ongoing, consistent, good cash flow for our investors. We also look at extreme weather factors. In this day and age, we're seeing more and more incidences of extreme weather, tornadoes, hurricanes, et cetera. And that has a cost effect on owning real estate, both in insurance and in incidences happening as a result of extreme weather incidences. So we'll look at a particular market and see historically what the incidences are of extreme weather, and we'll factor that in determining whether we want to invest in that market. And then we'll also look at, we particularly like to invest in Class B multifamily, large Class B multifamily. So we'll look specifically at Class B multifamily, the number of properties, the current inventory of large Class B multifamily, current vacancy rates, historical vacancy rates. We'll look at how much is being built and how quickly new multifamily is being absorbed by that particular market, and factor that in as well, because that can impact future vacancy rates and rent rates. So as you can see, we look at a number of different data points, and we'll just talk about a few right now. We won't go into all of them, but just to give you a sampling of the type of analysis that we do. So one of the first things that we do is we'll look at the population size. We're not interested in going into small markets or tertiary markets. They've got to be markets that are large enough to attract the large professional third-party property management firms that we like to work with, the best-in-class property management firms. So they've got to be large enough cities or MSAs to support that. Typically, we won't look at anything unless it's got at a minimum a population of at least 500,000. We're also looking for cities that are large enough to support us building out a good footprint or portfolio of properties in that MSA or city. We're not interested in going into a city and just doing a one-off here and a one-off there. We think it's more effective to build out a presence. So the city's got to be large enough, and there's got to be enough inventory for us to do that. And then we're also looking into the future. When we go to exit the properties, the city's got to be large enough to attract future buyers to purchase our properties when we're ready to sell, after we've increased the value in those properties and we're ready to harvest that profit. So in addition to current population, we're also interested in cities that show ongoing, consistent population growth. We want to see at least 1% population growth year in, year out. So for example, if you look at a couple of the markets that we like, Raleigh, North Carolina, and Columbus, Ohio. In Raleigh, you can see consistent every year above 2% population growth. In Columbus, you can see consistent every year above 1% population growth. Compare that to a city like for example, on the bottom of the right chart, Chicago, every year people are leaving. It's got a population decline. Or Los Angeles, it's flat and now it's slightly declining. We like to see the opposite. We like to see ongoing population growth that supports ongoing rent growth and ongoing high occupancy. So in addition to population growth, we also are looking for net migration or immigration moving into the cities that we're interested in investing in. That ongoing migration in can be both people from other cities and other states in the US relocating there, and it could be international migration, people from outside the US relocating. And the nice thing about international migration moving in, they have a much higher propensity to rent than US citizens do. So that's a nice bonus that we see from migration from outside of the US, is you're going to have a higher percentage of those people who are going to be renters than owners. So for example, if you look at a couple of the cities that we like, Raleigh, again, you're seeing a strong net migration in. For Raleigh, you have more domestic migration in than international migration in, but you still have both a net domestic and international migration in. Orlando, on the other hand, both net positive domestic migration in and net positive international migration in. But in Orlando, you have a higher percentage of international migration coming in than domestic coming in. And if you compare that again, for example, to Chicago and Los Angeles, you see there's a net migration out. So there's a large percentage of the people relocating to other cities and states out of Chicago and Los Angeles. And so, as I mentioned, we do a lot of economic analysis. We really look for ongoing job growth. But within ongoing job growth, something that we're attracted to are cities where we're seeing a large component of that job growth being STEM-related or technology-related jobs. And so, for example, here you see the U.S. average job growth is about 1.7%. And the cities on this chart are cities with consistent job growth, positive job growth, but these are also cities that have a dynamic tech or STEM-related component to their job growth. And again, you see a few of the cities that we're tracking: Raleigh, Columbus, and Orlando. And so we also look for markets where home prices are consistently rising. It's an indication of a vibrant economy. It's an indication of ongoing demand and increases in the number of households. And so one of the rules of thumb that we look for is we want to see at least a 40% growth in the median price of homes from 2000 to 2016. So for example, this chart here is a chart of Columbus, Ohio median home price. And you can see it's grown 42% from 2000 to 2016. It's a very strong market. But we don't just want to look at household, the growth in the value of the homes. We also are looking for that delta between the cost to own and the cost to rent. The greater the delta between paying your mortgage and paying your rent, the higher likelihood that there's going to be a strong renter base there that can't afford to own and will be renting. So for example, if you look at a few of the cities that we're tracking, you can see the deltas. Orlando's got a 20% difference, Columbus a 14% difference in owning versus renting, Kansas City and Raleigh-Durham 11% difference. So very strong deltas between the cost to own and the cost to rent in these cities.
Great. So we talked about the demographics. We also talked about some of the performance indicators. We talked about markets, which was a very good subject to talk about, especially with multifamily real estate. And so let's just talk about the types of multifamily and the grades of multifamily that we're very choosy about, because we're building our platform against a very specific grade and type within the asset class in order to achieve our goals. So looking throughout the commercial multifamily sphere on the type side, there's a wide variety of types of multifamily. I'm just going to choose a few here. The first one, just very broadly, are high-rise and mid-rise buildings. These are usually 4 to 12 plus floors. You'll see these a lot in urban settings, right? But also with the mid-rises, you'll see them out in suburban settings as well. They usually have higher construction costs, higher renovation costs, and one of the reasons why is because they're built, they're more dense, they're built on a smaller kind of plot of land, as it were, and they're building vertical, so it's more difficult to it's more difficult and more expensive to build or renovate within those buildings. There's also parking considerations that you have to consider when you're looking, especially at high-rise and mid-rise properties. These typically have elevators. You'll see the HVAC units, rather than being on the ground, they're going to be up on the rooftop, which makes it difficult. Imagine trying to replace 3 big giant HVAC units on the top of a 30 floor building, 25 floor building on the high-rise size. So that all of that stuff can be very, very expensive. I would say, especially on the high-rise side, if you're looking to invest in that space, it's really, you have to think that you're going to be going in with a lot more money. These properties are very expensive to not only build but also to maintain. So in terms of pricing and things like that, it's more difficult to get into them. Along those lines, you also have mixed-use buildings, and I include them because you see these a lot, not only in suburban areas, but also in urban areas. And they're building a lot of these throughout the country right now. So mixed use, basically, they can be high rise, they also can be mid rise, and they usually have the element of the first or second floors being retail with office, and then you'll have some residential units above. These are what they typically call the live, work, play communities, but also because of the reasons in the high rise communities, they have more volatility than not. And that's because it's difficult to add amenities, and some of the other reasons why I mentioned about high-rise and mid-rise buildings. You also have townhouse style. These are usually 2 stories. They have larger units. These are those types of buildings that they're either situated as like little row houses, and they'll have a separate front entrance with maybe a garage or a front yard and a backyard, but they're kind of connected with a shared wall in between. Or you might have just 2 houses sitting side by side. It's almost like a duplex type of situation, but completely separated off. They usually have internal stairs. So once you go inside, you'll take stairs up to the 2nd or 3rd floor down to the basement. They're not as efficient as the garden style properties. And we'll look at townhouse style. It's not our main focus, but usually what we like to do is we'll focus, and I'll talk a little bit about garden style apartments. We like to focus on garden style, but sometimes we'll find properties that have a few townhouses within the unit mix on garden style. And so speaking about garden style, these are the most typical types of commercial multifamily buildings out there. They're the most kind of widely built throughout the country. There's a wide array of floor plans and unit mixes. There's tons of inventory on the garden style. You can see some pictures here. There's a southwestern version that would be kind of out in Arizona, New Mexico, even in Southern California. And then also down below it, you can see an example of a garden style apartment building out in the Midwest, the East and the Southeast. A lot of them look very, very similar. Renters are very used to this type of building. The floor plans they're very used to. Usually they're about 2 to 4 floors. They have apartments on each floor. You'll see a lot of green space with these, so lots of trees, lots of grass, lots of amenities, usually pools. They'll have offices, sometimes tennis courts, things like that. They won't typically have elevators, although you might find some in say 4 floors on student housing, things like that. You might find an elevator. These are much less expensive to maintain. It's much easier to add amenities to garden style apartments as well. In terms of multifamily grades, and these are really just talking about the quality, starting with the age and of the different types of buildings. So we're not necessarily talking about neighborhoods, although a neighborhood can affect the grade of building. So at the very top level, you have what we call grade A buildings. These are your newer build type of properties. These are typically built in the 2009 to current, right? So about 10 years old. These are the most expensive types of product that are out there. They have the best amenities, usually set in the best markets and in the best neighborhoods. But they're also the tip of the spear in terms of rent growth. Right, the people that are living in these grade A communities are people that can afford to live there, and so they're willing to basically pay. They're basically willing to pay for the experience of living in a grade A community, right? So not only do they want a nice, safe place to live, but they're also willing to pay for add-on amenities and amenities you might not even think of, and also just the proximity, the location to work they're willing to pay for as well. They also have lower maintenance and capital improvement needs. And that's usually because they're newer build, and so you're not going to see a lot of deferred maintenance with these properties. And because of that, these are the most expensive types of properties when you think in terms of just sheer value in the marketplace. These are the most expensive because they're considered the less riskiest properties on the market. So you'll see lower cap rates here. These are the trophy assets that foreign investors are looking to purchase in, say, Los Angeles or New York or even Dallas and other big markets. We call these in the industry, we call these core or core plus type of properties. If we're thinking in terms of return profiles, because of the risk, the low risk kind of nature of these, you're going to see cash on cash returns in the 3 to say 5% range, and perhaps a high single digit IRR after the sale of the property. And of course, these are the easiest to lend on. You have plenty of lenders that would be willing to lend on Class A properties, right? So you're going to get the best rates on these properties, but also just imagine, because you're paying more for them, you're going to have thinner yields on these, right? There's not a big play to improve the value by forcing appreciation, as Zach mentioned earlier. Then we have the grade B properties, and this is the widest, again, the widest kind of grade of building that's out there. These are your mid to late 80s, all the way up to the 2009 kind of build here. I'd say about a third or more of the apartment product out in the United States are grade B type, and within that sphere, you also have B plus, you have a B, and then you have B minus. So there's kind of a good scope of quality within the grade B. These are, so I would say these are a little bit older than the Class A or Grade A properties. And so the quality, like I just mentioned, they vary very widely based on the property management, the property manager style, the owner's kind of capital improvement that they put into the property, and alongside that, just how much deferred maintenance there is. So you can literally have the same size in the same neighborhood, built in the same year, grade B property, but one would be considered a grade B plus, and one would be a B minus. And a lot of that has to do with just the deferred maintenance and the money that was put into the property over the period of time. These are still clean, safe, and nice places to live, but they're not the newest on the market. So for the B pluses, we would consider these core plus types of properties all the way to what we call a value add type of property, where you have some deferred maintenance, or maybe rents are below market, or property management needs to be replaced. In terms of return profile, you can typically expect, say, the 5 to 7% plus on the cash on cash returns. You'd have some low to mid-teen IRRs. Again, because there's a wide variety of quality within this sphere, it just depends on what types of work you have to do, and how you can force appreciation within a specific property to get those returns. And we have grade C properties, and these are usually about 35 plus years old. These are the older properties that you have. More than likely, they'll have moderate to a large amount of deferred maintenance. If you think in terms of 35 years plus, most mechanical components of the building are going to be at the end of their useful life if they haven't been replaced already. So definitely the roofs, which usually have about a 20, 25 year lifespan. You have your HVAC units, which last a little bit less, probably about 15, maybe about 15 years mostly. So if they haven't been done, if they haven't been replaced, you could be coming into a property in the grade C quality size with a nice size, what we call CapEx check to write in order to take care of the deferred maintenance on a property. Other deferred maintenance items you definitely have to look at in grade C properties, these older properties, would be the plumbing, the sewer, the wiring components, and also definitely the interiors, upgrading the interiors, things like that. It's a lower quality environment. Typically, the grade of tenant's going to be a little bit lower. This is really strong workforce housing. These are paycheck to paycheck type of people that might be living in these properties. But you might have a nicer C plus property in a nicer area too that's been upkept, and so the tenant profile might be higher quality and still affordable. These are called value added and sometimes opportunistic types of investments. You can expect, say, 7 to 10% plus cash on cash returns, and these would be the high teens plus IRRs. Just depends on if you have a value add or a real strong opportunistic type of investment. And on these, for the grade C's, the lending becomes a little bit more difficult. You have your regional and local banks that would probably be willing to invest in grade C properties. Bridge loans are very common, and some agency lenders will look at grade C properties, just depending on how much in reserves that you have, and what the tenant quality is, and economic and physical vacancy is. Then you have your grade Ds. These are just on the age profile. These are your properties that are, say, 40 to 50 plus years old. These are older. More than likely, these grade D buildings are going to be in neighborhoods where you might have to collect the rent with a gun, right? And so the quality and the age of the property just basically reflects the tenant quality and neighborhood grade as well. This is very strong workforce, blue collar housing. Unfortunately, a lot of kind of subsidized housing. Sometimes it's difficult to keep your rent rolling, keep it stabilized. We call these opportunistic type of investments. And lending can be very, very difficult on these properties. Also, selling these properties can be very, very difficult as well. And a lot of times it's because it's difficult to get financing on the back end. So trying to create to force appreciation, increase the value, and then sell at market rates might be difficult if you haven't transformed it into a C-class type of property. A lot of people pay cash for these, or they use bridge debt on these. For our part, I'll just say that we typically like to improve properties themselves and not neighborhoods. And so a lot of grade D type of war zone properties are things that we stay away from. And just go back on that one real quick, and I just want to mention one last thing is that, in thinking in terms of us improving properties and not neighborhoods, when we're looking to invest our money or our investors' money, it doesn't seem like the best way to go about doing that safely. Our whole kind of profile and going out there and investing alongside of our investors is preservation of capital and minimizing as much risk as possible. So grade D properties don't necessarily fit that profile. So above all, I just like to say that all grades that I talked about, all of the types of commercial multifamily I talked about, they're all viable, right? And it just depends on what your strategy is in investing, right? But for us, when we were putting together and creating Prosperity CRE and our platform, we wanted to kind of find and develop a portfolio that we can put our money and our friends and family money into, right? And we also wanted to, and you might hear this, somewhere down the line, but we wanted to create and build a platform that achieves everlasting wealth. Yep. Do you lose me? Hello? So I'd like to say just from the outset, all of the grades and types of commercial multifamily that we just talked about are viable in terms of investing. But for Prosperity CRE in the building of our business, we wanted to try to find and develop a portfolio that we can put ours and our friends and family's money into, right? And so, and you also hear us talk about this, down the line somewhere, but we also, one of our major kind of missions is to basically achieve everlasting wealth. And we wanted to build an everlasting wealth platform. And so when we were looking at commercial multifamily, we wanted to see how we can make money in every single market, right? And how can we handle both the economic and the demographic moves that happen? So a lot of what you hear us talk about is managing, it comes from a risk management or structuring away a risk type of perspective. And that's not only in commercial multifamily, but also just in commercial real estate, of which we own some properties as well. So our focus, and we landed on focusing our approach on B-grade garden style apartments in nice, safe neighborhoods, and also in stable growth markets with diverse economies. And why is that? Well, in terms of type, we found that garden style apartments, they provide the most safety and growth, right? And part of that is because there's just lower structural costs and complexity in running them. Because they're spread over a more or less dense kind of area, you can easily add amenities fairly cheaply. You can add buildings, you can take buildings down, you can do interior renovations, and you have the ability also to scale, right? If you have a bigger kind of plot of land and you have available room to build more, you can scale up relatively easily. Also, it's the most common unit type, right? So there's a renter comfortability factor there. Within any kind of submarket or market, if you have some renters that are moving from one B property to another, they're very familiar with the types of units there are, right? You have a kitchen, you have an entryway, you have a bedroom right down the hallway. And so there's a big amount of comfortability there for the types of renters that we like to look for. Also, the lender and the property management, there's a huge amount of experience in the space with this garden style apartment. And because of that, we're able to structure away a lot of the risk on both of those sides. So we can structure loans that we know the lenders will be more amenable to lend on. And also with property management, property managers that we team up with our professional third-party managers, best in class, and they have a huge amount of experience to augment our experience in the space. And I also mentioned, yes, that the less expensive data amenities. In terms of grade, we like B grade garden style properties because it offers the best blend of advantages, right? The B grade, it serves the largest and the most stable pool of investors or renters. And so if you think in terms of the people that are willing and able to rent B grade apartments, you have your blue collar workers. It's still affordable for them. You have your students, you have your young couples, you have your young executives, all of which create a renter pool, a potential renter pool for this type of property that's the largest out of all of them. It's also well insulated against economic pressures, right? It's not trying to be the market leader. It's not trying to be the tip of the spear in terms of rent growth and things like that, like A-grade properties are. And then there's the largest value range. So in terms of rents, you have the ability within B grade and garden style apartments, you have the ability to have nice studio size apartments in the 500 square foot range, all the way up to 2, 3 bedroom, sometimes 4 bedroom townhouses within a community that, you know, you can get rents all the way up to or I'm sorry, you can get the sizes all the way up to, you know, over 1,600 square feet, depending on the property. So there's a huge amount of variation within the unit mix that's possible. And of course, there's tons of different lending and property management office in the same way as there is in garden style apartments.
So how do we help you? Let's take a step back and talk about how we go about acquiring commercial multifamily investment properties and how our investors invest alongside us. So when we identify a property and acquire it, we form a separate entity, an LLC or limited liability company that is a sole purpose entity or SPE. That entity owns 100% of the property that we're acquiring. And when you invest with us, you're investing and purchasing a fractional ownership of that sole purpose entity. And so what that does is it gives you the ability to get all of the benefits of owning Class B large commercial multifamily real estate without having to write a multi-million-dollar check to get those benefits. You can invest fractionally with us for $50,000, $100,000, $200,000, $500,000, whatever the amount is, but get all of the benefits that we've discussed. In addition, we talked about the various types of lending that you can see in multifamily. When we're acquiring these large Class B commercial multifamily properties, we're typically acquiring it using non-recourse debt, which, as a reminder, that means the lender can only go after the property if there's a default. They can't come after us, they can't come after you. So there's no debt liability to you as an investor. In addition, there's also no legal liability to you because we're having you invest as a limited partner via this limited liability company. And of course, all of our properties are fully insured. So there's no legal liability to you as well. And the other item that Mark had mentioned is we're investing alongside you. So we're not some of the other real estate investment groups out there, syndicators out there, they'll put a deal together, they'll bring in passive investors, they'll bring in the lender, they'll acquire the property, they'll place a third-party property management company on that property, and then within a relatively short period of time, they'll sell the property and move on to the next property. But we don't do that. We're long-term investors. We believe in these investments, and in fact, the bulk of our net worth is invested in these investment property portfolios. And so we're investing alongside you the entire time. And so, you know, we're constantly out there looking for new properties to acquire, but because we have a very rigorous criteria that we apply to make sure that we're able to deliver on the returns that we're projecting, ultimately we're only acquiring about 2 to 3 new properties each year. And then we're also constantly growing our investor base. Most of our investors are repeat investors and referrals from existing investors referring their friends and family. We do occasionally hold events in which additional investors will come in as well. And we allow both accredited and sophisticated investors into our investments. As we had mentioned at the outset, all of our investments are Securities and Exchange or SEC compliant. And under those guidelines, Some of our investments, we bring in accredited investors only, which briefly are investors who have a net worth of at least $1 million, not including their primary residence, or investors who have annual income for each of the last 2 years of at least $200,000, or along with their spouse, at least $300,000. Those are accredited investors. Sophisticated investors are investors who may not meet that net worth or annual income requirement of being an accredited investor, but who have sufficient business or investment experience or acumen to make an informed decision about investing. And so some of our investments are only open to accredited investors. Others are open to both accredited and up to 35 sophisticated investors. As we mentioned, we are long-term holders of real estate. So typically when we acquire a property, we'll do our full business plan, and as part of that business plan, look at the optimal time to sell a property. And it's usually going to be somewhere along the 4 to 7 year time horizon. But we want to hold the property long enough to implement our value add strategy, and then to benefit from that ongoing heightened cash flow that we're receiving from increasing the value add strategy and increasing the NOI and building that equity growth. And then we also want to hold it long enough to minimize the taxes on sale and the transaction fees.
All right, so let's just talk about taking the next step with us. If you want to learn more, you can ask us for one of our investor questionnaires, or just give us a call or an email. We can, do a short private consultation. Our phone number is on the screen here, and also you can drop an email at investors@prosperitycre.com. That's investors@prosperitycre.com. Thank you very much, and we look forward to talking to you very, very soon. Bye.